All right, so now we'll wait to see over here when we're live. I never watch these back because I always imagine it's just me staring, waiting for us to go live. Oh, there we are. So, welcome back, everybody, for episode 8 of our Back to Basics series. I go over this kind of every time, but I'll try to make it quicker and quicker for those of you regulars. Essentially, what we're doing is we're taking some people from trade ideas who have not traded before, and we're going from absolute what is a stock all the way up to automated algorithm AI machine learning trading. So to date, if you haven't seen, there's a playlist on the Trade Ideas channel and one on my channel as well, which is youtube.com/bonpara, which there'll be something at the end for. We've gone through what is a stock, how stocks changes, how brokers work, how exchanges work, 6 or 7 lessons on technical analysis. And I was just telling guys before we started, this may be the final technical analysis lesson. Kind of making this up as I go, so if I think of something, I'll do it in. So next week we may go into fundamental analysis and then start to deal with some news and then how to pick stocks and that type of thing. This week we're going to talk about very basic. These are topics that you can go really, really deep on. Myself, I study the basics of and use periodically, but not often. But it's Elliott wave theory and Fibonacci ratios, and we'll go into those as well. So let's go into what we did last week, where we went over technical indicators was the theme of last week. We talked about moving averages and RSI and MACD and kind of your standard technical type indicators. So did anybody have any questions from that last week before we move on here? Bueller? No? Okay, perfect. So this is going to be split into two. So we're going to go first into Fibonacci retracement. So first of all, and this is where things kind of get a little woo-woo right off the bat, is what is the Fibonacci sequence? So it's essentially a sequence of numbers that are found all throughout nature and used in many things. I got some pictures here. There's a seashell, and I think this is a forget the name. You eat the plants off it. It'll come to me later when I don't need it. And a sunflower. And essentially what this Fibonacci ratio is the number plus the number before it in sequence, right? So 1 + 1 = 2, and then 1 + 2 = 3, and 2 + 3 = 5, and all the way down the line. Don't worry, you don't need to know that. It's just a common tool that traders use. So I wanted to talk a little bit about, first of all, I think why I think people use it, and I think it's because there's a lot of numbers that people try to see or try to fit, and sometimes they do work, but they exist all throughout nature, right? So the most common one, and the one that I try to quote a lot, is the 80-20 principle. If you go into a farm, it's 80% of your peas come from 20% of your pea pods. In business, generally, 80% of your revenue comes from 20% of your clients. There's a lot of different land mass values, sizes of the human body. There's a lot of things that fit in, and same with the Fibonacci rule. You see it a lot in natures and the way planets move and the way, again, these plants, these ratios exist all throughout nature. So, of course, in people's quest for more and more profits, it's seen quite often in trading. So how is this used in trading, and why is this important? So you can see this goes, and this will kind of be the last bit of the theme we've been developing throughout, which is talking about trend and support and resistance, right? So we've determined that the best and the easiest way to trade and to profit is to look at stocks as they move in trends. And we know that trends don't exist in straight lines up or straight lines down. They exist in these waves and these bounces. The stock moves down and then profit takers come in, and we've talked about this kind of ad nauseum. And we've talked about how quite often if something breaks down through support, it will come back and touch support and then move lower, and why that happened with my 2 timing bastard play. Sometimes if you see a big move and you want to get in with the trend, you may want to use some tools to estimate where that trend may reverse. So this is a perfect example where this is something I just got off the net. It's a Forex pair. It's the British pound over the US dollars, but people use it for stocks and futures and basically everything you can trade. Essentially what they'll do is they will use these ratios that have come up in Fibonacci. Again, I'm not going to quiz you on the numbers or anything, but just know that there's 3 that are super common, and that's 618, 550, and 38.2. So the reason I think these work even without being Fibonacci ratios is essentially we're talking 2/3, half, and 1/3, essentially, give or take 5%. So quite often what people will do is they'll look for, in a strong trend like this, they'll map the top of the trend and the bottom of the trend, and they'll say, okay, well, if we retrace, say, half of this move, that's where I'm going to start to enter my trade, knowing that, you know, if we get up way back up into this area, it's no longer really a trend, it's more of a reversal. So people will use these Fibonacci ratios and theories just to say, in this area of a pullback to a trend is where I'm going to start to possibly short this stock for a continuation lower. And this is a tool that we have in Trade Ideas, not quite the drawing tool on the charts yet, but we can actually say, we can go into Trade Ideas and say, I want stocks that have moved significantly and now they're in this kind of 1/3 to 2/3 range, so that you can find a bunch of stocks that are in this area of the trend to look for that as kind of your starting point and where you may initiate a position to catch the continuation of that trend. So that's the basics of Fibonacci. So, you know, the reason I glossed over the numbers is because they make it sound very complicated, but in sense, it's very simple. And it's something that when you guys study a lot of trading and you follow a lot of people, you'll see a lot over and over and over again. A lot of people use it. It's a tool to keep you on the direction of the trend.
What were those numbers again? Because it's really tiny. And
Sorry.
I just want to make sure I heard it right.
It's the exact numbers are 61.8%, 50%, and 38.2%. But essentially the way I like to look at it, because there is no magic to this. A lot of people like to think there is. But I like to look at it as if you took the entire trend. So say the stock moved $1, right? So you might look at it and say, okay, if we pull back 30 cents, that's about 1/3 of the move. That might be where you would start. Or you might say, if we pull back 50 cents, that's half of the move, right? So we've dropped $1 and we've bounced 50 cents. It's half of the move. And we may look for that to continue lower. And at the same time, this 61.8 is essentially 2/3 of the move, right? 66% being 2/3 and 33% being 1/3. And it's basically all kind of around half of the move. And then what a lot of Fibonacci theorists will say is that as long as we don't really break 2/3 or this 618 retracement of this move, it's still a valid trend. So it's still a trend as long as this, pushes down and doesn't bounce higher than 2/3 of the original move down. Another way that people will use these is they'll use them as projections. Sorry, I think that's at the next here. So you can see how quite often that this can actually come with the other things that we've talked about. So the trend being the thing that I'm really hitting home on, because it's something a lot of new traders try to do, where they try to pick tops and pick bottoms, where going with the waves and with the trend is by far the easiest way to do it, even though it's a bit counterintuitive. And you can see that quite often what traders will look for is confluence of different things. So for example, right, here's an area of resistance that's now come an area of support, but is also half of this move higher. So they'll look for these areas where there's 2 or more things lined up. right? We talked about indicators, how I don't believe that indicators by themselves mean anything, but they can be used with other things in the market to line up. So you might say, for example, if you decide to be a trend trader, again, I keep harping at home, but you guys will end up doing what makes the most sense to you. But what you may find is that, okay, I want an area of prior resistance that's now support to be an area of entry. I also want that to be somewhere in this kind of Fibonacci zone that I talk about. And then I might want an RSI, which we talked about as that overbought, oversold indicator, to be showing oversold. And this is the kind of checklist that you'll build as you're trading, where you'll look through your stocks and you'll say, okay, I need 3 of 5 things to trigger in my direction in order for them to make sense. So this is why I present all these things to you that are related to trend and support and resistance, but a little bit apart from it. It's to kind of build yourself a framework of these are the things that I need to see in order to take a trade. So here is another way that traders will use it, where they'll essentially use projections. So when you're in a position, it may be very hard to say, okay, at what level am I going to get out of this trade? Where's my target? You know, I'm buying a stock as it's moving in my direction. Where do I take profits, right? If say there's no resistance or no support anywhere, the stock is at all-time highs and it just keeps going. A trade is not finished and you don't make any money until you're out. You know, you see money on paper, but you can't actually go to the bank and buy anything until you've sold the position. So what some traders will do is they'll take the size of a move like this and they'll say, okay, if I'm buying somewhere near here, I'm going to either take 100% of this move, or I'm going to take 100, and again, this 2/3, right? This 618, which is essentially saying I'm going to look at whatever the last move was, and I'm going to try to get the last move plus 2/3 of the last move, and that's going to be a target. Again, I'm going quickly over this because I don't really see a whole lot of value to Fibonacci itself, but I like the concept of taking whatever the move was and taking a percentage of that move and then using that as your entry point. So again, if you say, well, I'm going to wait for a stock to pull back 50 cents, that might make sense on a $10 stock. It wouldn't make sense on a $100 stock. Wouldn't make sense on a $1,000 stock, right? So by using what the prior price action of the stock is as a way to kind of compare what you want to do with that stock in the future makes the most sense to me. And this is something that this Fibonacci and Elliott wave, which is on the next slide, will talk about. Basically saying, what was the prior move? Let me use some retracement of that prior move as my entry signal to get back into this trade. All right, so any questions about Fibonacci before we move on? Again, these are the trend and support and resistance. These are the things that are super important to me, so I left entire half-hour lessons to them. These are things that you'll see and I think are important for you to kind of look at, but really if you want to get into, you can definitely read about them. But it doesn't have as much to do with the core mechanics as kind of a way to tailor your trading to go forward. Okay, so Elliott wave principle is the next one, and this is essentially a concept of crowd psychology. And you guys see me quote crowd psychology all the time. It's essentially what the only value I think that technical analysis has is related to crowd psychology. It's just trying to figure out what the masses in total are going to do. So for this, for example, what we're looking at is we're essentially looking at someone, Elliot, I don't know if his last name's in the description here. I just took this from Wikipedia, but essentially he saw quite often that a stock generally moved in 5 predictable waves up and then corrected that move in 3 ways. So not all the time, but quite often, there would be this that we talked about a lot, but a 5-wave move higher, right? Whereas this would be 1, 2, and then 3, and 4, and then finally 5. And then as the stock retraced, it would retrace in a 3-wave pattern. So they would call that A, B, and C, essentially. So the theory here being is that you have the first wave, which is kind of the initial group of people getting into it. There's going to be a whole bunch of people that miss that first move. So when it pulls back and starts to move higher again, you have the masses get in. And the masses get in and they cause the third wave. And the third wave, according to the Elliott wave principle, has to be the largest wave in the sequence. And then as it comes down, you have the people who've missed the first 2, and they'll push it up for one more time. And that's kind of the final hurrah of the stock, and usually leads to the end. And so quite often it's what they like to quote as the smart money who knew something was up, followed by the crowd of traders who missed the first move, followed what they usually call the dumb money. Right, and you can see that in my drawing it's bad, but in these diagrams, the 5th wave is the smallest wave and then causes the correction. They think that's the dumb money. We always used to call this in trading back in the day, at least in my little Halifax prop firm, we called this the dentist effect, which essentially was you knew it was a good stock when first the people involved. So Google, for example, right? Google was big in universities before it hit anywhere else. That's who was interested in Google and was buying Google because they were the people on the cutting edge of that technology at the time. Then the traders came in, and the traders are the people who saw the first move in Google, talked to the university students, tried to figure out what was going on there, rode that second wave up. And then the dentist effect is that when it's the people who are just hearing about it after the people in the know and after the investors and the traders, your dentist says Google's a good stock. Well, it's probably already up a couple 100% and they've missed the move, right? So that's essentially more or less a very dumbed down, before I get, some real crazy Elliott wave people yell at me. That's a really dumbed down kind of concept of it. And then the fact that the 3 waves down essentially just means that you have first group of people taking profits, you have a bounce. When that bounce fails to make a new high, you have the kind of crowd running for the door. And these are all long, but you can flip these as well.
Quick question. If it went down, so it only goes down ABC, and if it went down one more, then it wouldn't be an Elliott wave, it'd be something else.
Yeah, well, what they would do...
D, you wouldn't even consider that the Elliott wave?
No, well, because then what they'll consider it is more of a trend reversal. So then it would have its own numbered sequence on the way down. So these are all longs, but you can have the same count. Basically, you count with numbers in the primary trend, and then the letters are the reversal of the trend. So if any of these were pointing lower, it would be, right, 1, 2, 3, 4, 5, and then it would be ABC up. Right, so the numbers kind of indicate what the primary trend is, and then the letters indicate the retracement in that trend. And then again, the theory talks about how this is fractal as well. So if you have a big, and it's kind of shown here, I know it's small for you guys, it's bigger for everyone else, but within each wave, there would be little microwaves. So in a third wave on like a weekly time frame, there would be a 5-wave move on a 15-minute or a daily time frame.
So you don't know if it's an Elliott wave until it's all said and done, right? Or...
Elliott theorists will say everything's an Elliott wave. That's the thing, is this is the way they structure their entire view of the market, right? That's the difference. Is you're not really looking at it and saying, is this or is this not? If people get into this theory, and again, there's things that I love and hate about these types of theories, and I always look at it as like none of these theories, just like the indicators, are good on their own. Like, if there was a way that you could just do it. It would be programmed into a system, and that system would ruin it eventually. But these are guides that can help you. So for example, someone may look at this move, and I always think that wave 5 is probably the best one to get, just because the trend is already established in your favor. But what someone may do is they may look at the beginning of a trend of this stock, and they may count this wave and see the wave 4 pullback. Then they'll grab the Fibonacci tool that we just talked about and said, okay, I'm going to mark wave 3, and I'm going to say, okay, when it gets to 1/3 or half of the pullback, which may also be support from back here, that's when I'm going to buy, right? So, you know, I'm trying to teach you the frameworks of how market moves, but then at the same time, it's all about combining these things into your trading plan. So what I'm hoping is that there's some of these things that each of you will grab. Maybe someone really like the indicators, right? And they like the MACD or whatever. And again, I don't think any of these things on their own have a lot of value, but all of them together may. Like this Elliott wave might be speaking to another one of you. So when it comes time that we build our trading plan and we put everything together, each of yours is going to look a little bit different, but it's going to say something like, okay, I want to buy pullbacks in the trend. Someone may buy pullbacks and they may like the concept of the Fibonacci pullbacks, and they'll look to buy there. Someone else may say, well, I just want to buy as the thing is breaking out of the prior high, but I want this indicator to confirm that I'm correct. And when we get into fundamental analysis and statistical analysis, there might be something might speak well there. I'm very statistical analysis type of guy. So you may say, okay, I want to trade with the trend, but I'm only going to trade these back-tested type results that I get from trade ideas. So, you know, I'm kind of showing you a bit of everything, and then what I hope is that the ones that kind of speak to you, you dive a little bit deeper into after that. So again, this is just the basic structure, just kind of blown up a bit of an Elliott wave chart that just shows your 5-wave move up and then your 3-wave move down. And there's certain rules associated with it. Like, for example, wave 4 isn't allowed to go deeper than this trough in wave 1, or they consider it something else. There's, you know, there's whole university level lectures that will go into this type of thing if you want to go deep. And then this is kind of what I'm talking about with the fractal nature, where on a wave 1 up, you see this kind of ABC little pattern down, and then on a wave 3 up, you see a little ABC pattern down, just showing that in Elliott wave theory, everything is compacted on itself. So if you want to get into this wave 3 move, you may say, okay, well, 60% of wave 1 is what we just talked about with an Elliott wave principle. So you may say, okay, I see this move up, I see this AB pattern down, so I'm going to wait for a C wave pullback into a 61% Fibonacci pullback with an oversold RSI at support, right? And these are, and I know it sounds kind of complicated and convoluted, but I think a couple weeks ago, Marissa had a question about, well, you can see these patterns everywhere, and that's true. But what's important is that you just develop a trading plan that makes sense to you. So that, you know, trading plan that I just riddled off may sound like garbage to a lot, might sound perfect to someone out there, and they write it down, and that's their trading plan. And that's how they see kind of the forest for the trees, for lack of a better term. And yeah, this is just a blow up nature version of, again, the kind of fractal nature of everything. And then here is just showing that it works in both ways, right? So a numbered wave is the primary trend, and then a lettered wave is the reversal to that trend. All right. So we went a little bit quick, but people had places to go and people to see, so we didn't want to drone out too long. But there are room for questions if anybody has any, and if anyone wants to clarify what's going on there or what we're doing next or anything like that.
Do you incorporate the Elliott wave a lot into your trading? Or?
I do. I don't number. I don't go as deeply as a lot of people do. I don't number everything out. But for example, if I do see a stock that has a multiple wave move, and this is just one that I was looking at for an example before we got here, where this may be considered a wave 1, pullback, 2, and then 3, and a little pullback. So I might say, okay, maybe this one has one more shot down. I use it the same as I talked about the way I use indicators, which is not what to do, but what not to do, right? Where I said I won't buy a stock that the RSI considers overbought. It doesn't mean that I'll short it up there. It just means that I might just say, okay, that's a bit too far gone. Let me wait for this indicator to chill out a bit. And it's the same that I'll do with Elliott wave. Now, Fibonacci, I actually do use Fibonacci retracement tools, but I use my 1/3, half, 2/3 as opposed to their exact numbers, just because it kind of makes more sense to me that a trader would look for a half of the retracement of the move as opposed to this kind of random correlation. So again, for your homework and for your scan this week, I actually built a little Fibonacci retracement scan that we have within Trade Ideas, which basically just looks at the move that initially happened. On an intraday basis, I think I'll expand this out so we'll be on more of a daily basis before I give it to you, but you can see here, and I know it's bigger for everyone else than it is for you, but if I move this, oh, that just made that way smaller for you, didn't it? It has a little description, and that description will say something like Fibonacci retrace 61.8%, and it will say, from the support, which was $4, to the resistance that was $4.26. And it will give you these little signals. Again, I'm going to expand this out so it's a little bit more daily chart for you. And then I just want you to take this scan and add it to the other things I gave you and kind of look at and say, okay, I'm going to buy things that are pulling back or bouncing up that is kind of with the trend. So that makes sense to everybody? You all going to do your homework, or I'm going to have to fly down to California and get away from Canada for a bit where it's still really cold up here?
Absolutely.
That's fantastic. Okay, so I'm looking at the chat, and I don't see any questions there either, so I think we will call it for today, and I will see you guys next week.